the system that I'm proposing would be much more comparable to the classical international gold standard for that very reason. I'm saying that the US could start it and show the leadership, but I would expect other countries, particularly our trade partners, to soon feel the pressure that they would likewise have to keep their currency convertible into gold through some link. And the extent of it, I won't speculate, but I'm not saying 100%. We certainly aren't in a position to back even the amount of Federal Reserve notes outstanding in gold. But to have some link to gold, as Ronald Reagan talked about, in some way, have a link between the dollar and gold, so it's the most trusted currency in the world, but require our trade partners to do something comparable.
Monaco 64, home of alternative economics and contrarian views. Today I have the pleasure of speaking with Judy Shelton. She is the author of Good as Gold. She was a nominee for the Fed governor post back in 2017 by President Trump. Recently, she's been talking about some kind of reset of the monetary system, gold reset, backed by a long-term gold-backed treasury bond. So, Judy, it's always great to have you on the channel. Welcome back.
I'm honored to be on with you. Thanks for having me.
Thank you for coming on. And we'll start with this editorial you wrote. Well, it came out on the 26th of October, so not that long ago, on the Wall Street Journal. And it says how American gold can shore up the dollar. A special treasury bond backed by the precious metal would strike a blow for sound money. So maybe you could talk a little bit about this idea.
Well, the idea of a long-term gold-backed treasury security is something that I have been proposing for quite some time. It's really the final chapter of Good as Gold, but it encapsulates the meaning of the title because, first off, it would be the first time if we were to do this, and I'm proposing next July 4th, 2026, as the U.S. celebrates our 250th anniversary of the signing of the Declaration of Independence, I'm thinking if we could issue, and I'm even proposing a 50-year Treasury bond, which is something that President Trump has long wanted to do, to go beyond our Treasury 30-year bond, which is currently the longest. But it would be the first time that there were any official link between the value of the U.S. dollar and gold since the Bretton Woods system ended under President Nixon 54 years ago in 1971. And the idea would be that people could purchase this Treasury security, special issuance, and at maturity, they could be paid either the principal amount of the bond, the face value of the bond, or a pre-established specific weight of gold. And I'm suggesting this is comparable to a TIPS bond, very popular offering, which is a Treasury inflation protected security, which compensates the investor for the decline in their purchasing power over the life of the bond, but it uses to calculate how much they are compensated for that, the consumer price index, the CPI. This is basically saying if you think that purchasing power is reflected in the price of gold, maybe because you see gold as a surrogate for commodities or even for the real economy, then it's the same idea that you would be compensated for the decline in the purchasing power of your investment because you have this option to be paid in gold at a pre-established rate. So that's the basic idea. And I don't know whether it could be offered as a savings bond. I've heard people say I'd buy one for every one of my grandkids. I don't know if it's something Treasury would issue alongside their array of Treasury securities, in which case maybe private firms, if it were popular, might try to replicate the payout. That is, they could start bundling traditional treasury securities with gold futures contracts. I don't know if other countries would then feel pressured to likewise issue some kind of sovereign security that has a convertibility to gold aspect to it. But that's the proposal.
Yes, and you spoke or wrote about in this editorial that yeah, the U.S. has about 261 million troy ounces of gold, and that, of course, that would have to be audited because there's a lot of people who question whether the gold's still there. Even President Trump did that, I think, earlier in the year. He said we're going to check if the gold's still there. But and you talk about the statutory price, which right now is at $42.22, and that was last changed in 1973. Prior to that was 1972. They changed from 35 to 38. And you say that would be a windfall, which I recognize, but how would it be a windfall for the issuance of these gold-backed bonds? Could you explain that?
Well, technically, I still need to learn more about how to do that. I'm aware how the International Monetary Fund was able to do simultaneous transactions. It was in the late 90s for both Mexico and Brazil, where they bought and sold the gold that those countries had deposited at the International Monetary Fund on the same day, and that allowed them to revalue the gold. And so that helped the countries pay back debt and be able to borrow more. I think the fact that it has happened by an organization such as the International Monetary Fund, which was set up originally to honor this convertibility aspect of the dollar into gold at that price of $35 you referenced, would be a good precedent. That is, I don't think it could be criticized. We know that other central banks did mark to market the value of their own gold holdings. The U.S. is unique in holding it at that statutory price. You're correct. That was changed, or it was finalized after trying to chase the gold price after August 15th, 1971. Paul Volcker, who was advising President Nixon at the time and was at Camp David when they closed the gold window, always thought they would reestablish the existing Bretton Woods system, but at a higher price. So they tried again at $38, but so much inflation had been unleashed during the 60s, they couldn't catch up. And they finally gave up and signed that Smithsonian Agreement in February of 1973 when it had gone up to $42.22. And they thought, this is hopeless. We don't know how much inflation has sent up the gold price. We can never catch up. And so it has been held at that price since. But it suggests to me, I'm not an attorney, but that there could be legal confirmation of doing capturing a windfall profit between the market value. I mean, the gold's worth over $1 trillion now, compared to the 11 billion book value that it's carried at, both on the books of our Treasury and as gold certificates for the exact same 11 billion held by the Federal Reserve. So I see an obvious potential to capture that windfall profit, which would certainly help in our budget future. $1 trillion would be a very worthwhile additional source of revenue if we're trying to balance the budget over the next 10-year horizon. And I would like to see something like that take place using both the IMF precedent, but also just the standard corporate practice of marking to market assets. And also emulating what other central banks around the world did with their own gold holdings.
Yes, and I mean, me and other channels on YouTube and other platforms, people who cover gold, who are sound money proponents, we've been talking about this revaluation for, yeah, for quite a while this year already. And even the Federal Reserve, the Board of Governors, published a paper by Colin Weiss back on August 1st talking about this, and it explains exactly how it would work. At the time, gold was at 3,300 an ounce. I think the other aspect of the gold holdings, and I think I don't know if you've heard of Jim Sinclair. He's passed away, but he was known as Mr. Gold, and he predicted the price of gold back in the early 70s would go to pretty much where it went in 1980, almost 900. And he took the debt that America owed to foreigners, treasury debt, and multiplied that by 40%, and he got that price. So that the U.S. foreign debt is backed 40% by gold. So today I did the calculation, and foreign debt is about 9.2 trillion. So if you take 40% of that, that's like 3.6 trillion dollars. And so that would mean gold almost four times where we're now. It would, if the US revalued it to, let's say, 15 or 16,000, you'd be able to cover the foreign debt with the gold. Do you think that could be something that the Treasury and the Fed are looking at?
I don't know if they're looking at it, but I'm very glad you reminded me of that piece that walks through how to do it by Colin Weiss posted at the Federal Reserve website. So that's interesting. There were a lot of rumors that the Trump administration was looking at revaluing the gold when there was talk of a sovereign wealth fund. And some people thought that's what they had in mind. I think Treasury Secretary Scott Bessent further explained that that wasn't specifically what they had in mind. They were looking more at lands and mineral rights and other things that the United States has, because the idea of a sovereign wealth fund was very appealing to President Trump. But I think that this is this would be a very interesting way to capture that money. But then I have people say to me, well, but if that just goes into additional Treasury revenues, which, since it is owned by Treasury, would be the natural, we don't want to waste that money. I've been asked if it couldn't be corralled in some way to keep it from just going into the general funds. That's another area that's going to take some legal sleuthing to decide if you can differentiate the types of revenue the government receives that goes to Treasury, because generally Treasury has to accommodate what Congress decides in terms of budgetary allocations. But that's also an interesting thought. I still think even if it had to go into general revenues, we'd be a lot better off doing it in this way and holding onto the gold as specific collateral for the duration of the bond, versus just having some president come in the future and say, let's just sell all the gold. Because
Yeah.
then, since we haven't gotten our balanced budget aspirations into any realistic plan, to me, that's just throwing it down a rat hole until we do.
Yeah, I recently made a video about gold revaluation, and I look back at 1934 when FDR revalued gold from $20.67 to 35. There was a huge windfall, and of course, that was from gold that was turned in by American citizens because of Executive Order 6102. But that windfall helped the economy quite a bit in 34 and 35, and it helped set up the Exchange Stabilization Fund, which is different than the sovereign wealth fund. But yeah, the other thing I mentioned, Judy, on that video is that let's say you had a windfall, or me, we found out that our grandparents left us this gold, but they always said, "Oh, it's $35,000," because when they put it in a fund or a trust fund, it was thousands of ounces at 35,000 at $35. But then you realize that it's worth 4 million. I mean, one of the first things I would do if I was in that situation, and if I had a lot of debt, is I'd pay off some of that debt, and maybe spend a little bit, but also try to invest it. So that's how I see gold revaluation for the US. If they do it, I mean, the fact that they've kept it at 42.22 seems like silly, but at the same time, it hasn't really kept Congress in check. If anything, Congress is like still spending a lot, but I
I
don't know.
like that idea, though. I like that idea. If you could specifically dedicate that the revenue raised, and I think it would be oversubscribed. I think people would pay a premium for this security, not just for the novelty of it, but just they like the idea that it's kind of establishing a beachhead for trying to move our country towards sound finances and sound money. And especially if we're looking at the next 50 years, because I think it forces the question in 2076 on the 300th anniversary of the US Declaration of Independence, are we still going to be here? Are we going to be a prominent force for good in the world? Are we going to live up to the dreams and hopes of Americans and maybe people around the world? Are we still going to stand for the American idea? We always hear that our fiscal situation is unsustainable. Well, where will we be in 50 years? Because people say, well, it's a long run problem, but we have to say this is day one of the long run. Now we're starting to address it. So I quite like what you're suggesting, that because paying off debt accomplishes the other side of the critical ratio. Some people in government think it's not the amount of debt, it's relative to the GDP and the growth path. Well, if you reduce the amount of the debt, you're really helping on that ratio. And I want to encourage the strong growth, and I want to encourage a better path. But then it would be helpful even if Congress isn't. It was Alan Greenspan who first wrote in the Wall Street Journal about how helpful it would be to have gold-backed treasury bonds in September of 1981. And he said it would put so much pressure on Congress, they would be so ashamed if people preferred the gold-backed bonds over traditional treasury fiat currency denominated in fiat dollars. If they showed a broad preference for the ones where the dollar was literally as good as gold, that would shame Congress. I'm not sure you can shame Congress, but he thought it would be helpful and send a strong signal.
Yeah, and the other thing, the counter argument to paying down debt is that in the fiat currency system, if you do that, you extinguishing currency and fiat money out of circulation. But if you revalue the gold up to a certain level, that will add on as well. You don't have to take the whole windfall to pay off the debt, so it would compensate for that. But anyway, Judy, I have some questions from someone that I communicate closely with, who's a gold bug, who's very much following what's going on in the international gold market as well, not just let's say the COMEX LBMA axis, London, New York, and it's to do with your gold back bond. And I asked my friend, I told him I'm going to interview Judy tomorrow, and he was really excited about that. And he said the 50-year gold bond are deferred gold payments. And that right now, the BRICS, under the leadership of China, they're actually working on having short-term duration gold bonds or straight gold collateral. I mean, there's talk. I think it was even. It's not Vince Lancy, but I can show you here. Vince Lancy, who's quite popular on X and talks a lot about gold. He's even mentioned that China enters central bank gold storage business. They're trying to get countries like Saudi Arabia, Cambodia, Vietnam, and others to use the Shanghai Gold Exchange vaults. and to create like a repo market and collateral market for gold that would challenge, let's say, London. So yeah, I don't know if you've heard of that and what you think.
Well, I think China was pretty smart a few years ago in setting up that gold platform in Shanghai, which I think operates out of the normal Chinese economy. I think that as far as capital controls and such. And my understanding is that while China doesn't have any gold-backed security or currency, when it purchases energy, say from Russia, that puts China in a position to pay in yuan, but at the same time to be able to convert a yuan denominated contract into a gold futures contract. So that works. And it means that you're just locking in whatever the gold price is, but it's a step closer to being able to provide some kind of payment denominated in gold. I was very interested in a New York Times opinion piece, came out years ago. I guess I shouldn't try to guess. I'm thinking 2011, maybe 2014. For some reason, those dates come up. But it was written by Kwasi Kwarteng, Chancellor of the Exchequer under Liz Truss. And he said he thought China would be the first country to issue a gold-backed currency, and that their aspirations to be the dominant currency and to kind of show up the United States, who walked away from being the anchor country for the international monetary system, would fit in with what they might want to do in terms of having dominance on monetary and financial issues internationally. So if that's the case, it's certainly consistent with their purchases of gold, some of which apparently people believe is taking place in secret, but some of which is picked up by the World Gold Council. And we do see China appearing to steadily accumulate, there we are, that Financial Times article, to accumulate gold. I was in France 2 or 3 weeks ago and met with Jacques de la Rosière, who was the former managing director for the International Monetary Fund. He's really one of the wise men of Europe and also headed France's central bank for some time. He brought out that they're getting concerned in Europe that the euro has been displaced by gold as the second preferred global reserve asset held by central banks. They were very conscious of that. For me, that is in favor of the proposal that I'm pushing, which because the United States, in a way, that's a 1-2 punch. I mean, here we have the existing dominant global reserve currency in the US dollar, but we also have by more than twice as much the highest level of gold owned by the government as official reserves than the next country, which would be Germany. So this would play to our strengths, I think, to combine the dollar and gold because both are now held as the 1 and 2 leading global reserve assets by central banks and really put us in a position to start maybe designing or at least setting the general terms for, in my view, a hoped for new international monetary accord or set of arrangements. Because one thing the United States is citing often as it pursues new trade agreements and imposes tariffs is President Trump has always been very vocally against currency manipulation by our trade partners. And I think has gone quite far in wanting to cite China for the unfair trade practices that allowed China to really hollow out our own manufacturing capabilities, which had negative social consequences as whole cities had displaced workers and through no fault of their own, American products were not able to compete successfully against cheaper imported goods cheaper largely as a function of their government's efforts to manipulate the exchange rate. So we call that competitive depreciation, but I've always taken the view there's nothing competitive about it. It's not competing, it's cheating. So, as much as our president has talked about how nice it would be to be honored with the Nobel Peace Prize, I think a greater prize and a rarer achievement would be to be the one who initiates a new international monetary system, one consistent with the goals and the logic of free trade, that would have a level international monetary playing field as the basic foundation for trade. And whether you limit trade to partner countries who agree and maybe likewise have their own gold convertible sovereign debt issuances, or you're converging to some kind of a fixed, inherently fixed exchange rate system, because once a country defines its currency in terms of gold through a sovereign debt issue that's redeemable in gold, you're beginning to establish, I think, the framework for a future monetary accord. So I'm hoping that this idea could turn into something much more important for world peace and world prosperity. I love international trade, voluntary commercial transactions across borders, but I firmly believe it has to be based on a level international monetary playing field, because otherwise you're not getting accurate price signals. Comparative advantage means nothing if it's obscured through constantly fluctuating exchange rates. And I think it would be the only ethical and orderly way to pursue a more broadly inclusive global marketplace.
Yeah, in your editorial recently in the Wall Street Journal, you talked about the Bretton Woods system that ran from 1944 to 1971, and I looked up on ChatGPT who were the signatories. There were 44 participating countries, and China was in it. And I know China wasn't communist at the time, but a lot of countries right now that are part of BRICS and the so-called Global South were part of it. So uh, I think it's in everyone's interest. And I'm not here to tell what the United States should do, but I think it's in everyone's interest that the whole world, like you said, trades and does business with a money that's sound, that's neutral. And up until 1971, I guess that was partly true, even though I think that, don't you think the Bretton Woods system was a little bit flawed in that only the dollar was backed by gold, and that was a result of the US having most of the gold reserves after World War II. Don't you think it would be better to have a system where every country's currency had to be convertible into gold, like the classical gold standard that Alan Greenspan talks about from the 19th century, that worked really well? So do you think President Trump is open to doing that? Let's say sitting down with the Chinese and other people and coming to an agreement like that?
Well, I do definitely think that the system is much stronger when each participating country is responsible for maintaining the value of its currency in terms of a fixed weight of gold. So, in that sense, definitely, I've always agreed with Alan Greenspan that the classical international gold standard was really superior in and supported free trade for that reason. When the U.S. That was a Keynesian idea to make it be just one country, and then other countries would just make their currency convertible at a fixed rate with that country's currency. And Keynes learned that from his own work looking at India, because he thought, why incur the cost of moving gold back and forth? Just have India keep their currency fixed to the pound rate. And But it turns out that kind of efficiency in the end makes it vulnerable. If the anchor country decides to walk away from that responsibility, which is what happened, and we know the aspects of the Triffin dilemma, and maybe it was ultimately not in the best interests of the United States and probably caused us to keep running trade deficits because we were providing the global asset. I think that the system that I'm proposing would be much more comparable to the classical international gold standard for that very reason. I'm saying that the US could start it and show the leadership, but I would expect other countries, particularly our trade partners, to soon feel the pressure that they would likewise have to keep their currency convertible into gold through some link. And the extent of it, I won't speculate, but I'm not saying 100%. We certainly aren't in a position to back even the amount of Federal Reserve notes outstanding in gold. But to have some link to gold, as Ronald Reagan talked about, in some way, have a link between the dollar and gold, so it's the most trusted currency in the world, but require our trade partners to do something comparable, maybe also for 50 years. So you could truly be looking at the value of their promise to redeem in gold relative to our promise to redeem in gold and look at those comparable yields. And then that would be a reflection of the country. But if any country then failed to either have the gold properly collateralized or people didn't believe that they could redeem in gold or they violated it somehow, that they would be punished, but it wouldn't undermine the whole system. It would just disqualify that country. And people could presumably convert their instruments into the same sort of sovereign with gold convertibility feature instruments of another issuing country. As far as President Trump wanting to do it, I feel like I was the first to talk about a Mar-a-Lago accord in that in a piece published in the Financial Times in September 2016, before he was even elected, I talked about the fact that his focus on the problems of currency manipulation sort of suggested this might be a new time to think big. I served on the President Trump's Economic Advisory Council at the time, and he told us, think big. Well, for me, that means the world needs a new international monetary system. And I said, if it takes place at Mar-a-Lago, that's a good thing. Let it. That's an international resort comparable to Bretton Woods, New Hampshire, where it took place with those 44 signatory countries, as you referred to them. As far as the BRICS, in the last 3 weeks or so, President Trump specifically commented in very clear terms that he saw countries joining the BRICS group as anyone joining was setting up an attack on the dollar. He definitely sees the monetary aspirations of the BRICS countries as a challenge to the dollar. He very much wants to keep the dollar in its predominant position as a global reserve currency. And he threatened to impose tariffs on countries that would do that. It's interesting to me because during the 30s, when these issues were so prominent, it was really the combination of tariffs and competitive depreciation that brought about that downward spiral in trade relations then associated with the Great Depression, because these were all beggar thy neighbor, taking advantage through unfair trade practices to try to increase your own exports at the expense of your neighbor. So tariffs and exchange rate arrangements have often been combined. So it was not inappropriate, I don't think, for the president to mention that. But it shows that he is keeping an eye on the BRICS countries. And in fact, we recently did that 20 billion currency swap for Argentina to help stabilize that nation before elections. I think I was at Treasury that day when Treasury Secretary Bessent introduced that. It was somewhat controversial. He did tap the Exchange Stabilization Fund, which you mentioned, which is allowed. Our Treasury Secretary can do almost whatever he thinks is needed, utilizing that exchange stabilization fund, and he did. But one reason we wanted to support Javier Milei and his free market reforms in Argentina was if it weren't for the election of Milei, Argentina was slated to join the BRICS countries in January of 2024. And he single handedly said, we're off that track. And that counted in Washington.
Yeah, that's understandable. As like a neutral individual, I see the BRICS. Yeah, maybe indirectly it is an attack on the dollar, but I also think it's trying to protect themselves from the fact that the U.S. has been using the dollar as a political weapon for the last decade or so with sanctions and freezing Russia's assets. So they're going to gold. They're not necessarily saying we don't want the dollar. So do you think President Trump sees things like this, or he's just trying to, I don't know, like push BRICS into maybe rethinking what they're doing? Because I think the challenge to the dollar is not really BRICS, but gold itself.
Well, I think that the reason BRICS wants to do it is, as you said, for the sanctions. The financial sanctions imposed by our Treasury are a very potent tool. I I am not big on freezing the reserve assets of other countries. I guess in the case of Russia, I was in Paris in the end of February of 2022, watching on television the tanks rolling into Ukraine. And it's different, especially for an American, I must say, when you hear about things happening in Europe, but you're safe on our continent, it doesn't hit you as hard as when you're watching a TV screen of what's happening for a country that's one time zone away. And I had really cut my teeth analyzing the Russian internal monetary and financial situation and the impact of Western capital on the Soviet economy when I first was working on a postdoctoral fellowship at Stanford University at the Hoover Institution. And I ended up writing a book about the Soviet Union. It ended up being published commercially as The Coming Soviet Crash because the country was going bankrupt. But you have to remember not only the trauma for Russia of having gone bankrupt, but when Putin came in 1999 under Yeltsin, within 3 weeks, Russia defaulted on its debt and absolutely plunged again into the financial abyss. And for Putin, owing money and being so vulnerable psychologically is a very powerful impulse for him. And I wrote a piece for the Journal at the time that they published, just saying, be aware that it's the equivalent of going nuclear in the financial world for Russia to freeze those assets because Putin, in particular, is keenly sensitive to, well, when Russia went so far into debt to the International Monetary Fund after the Soviet Union collapsed in December 1991, it took years to dig out and try to pay back those loans. But Putin very proudly paid them back early. So he bragged later. And this is a matter of pride and even kind of a psychological neurosis. He does not like to have Russian money called into question. He was going to great lengths to pay on the frozen Russian bonds and to release money through London, in fact, I think through the Narodny Bank, to ensure that if there was a default, it wasn't because Russia wasn't willing to pay. So I understand I understand that sanctions that our Treasury imposes and uses as a tool, I would want to review the use of that. And I know it's still a very sensitive subject whether the funds will be frozen, the Russian funds, and redirected and made available to Ukraine. I also understand those impulses, but I think in the financial world, you're playing with fire. And that's just my own thoughts on that. So sanctions should be used extremely rarely and with great prudence.
Yeah, because it wasn't just Russia. I guess it scared a lot of other countries that the same could happen to them, and I think that's why they've been buying so much gold. I think since 2022, it kind of coincides. And I just checked what you said about Putin and debt. And it shows because the public debt to GDP in Russia is only 21.5%. So what's that? Like 10 times less than Japan.
Yeah. Yeah.
Yeah.
Yeah. 5 times less than us.
Yeah, that as well. I wanted to ask you about silver. I know you don't really talk much about silver, but recently there's been news that India is going to allow people and companies from April next year to use silver as collateral on bank loans. And we also saw the Saudi Arabian Monetary Authority, I think they're called SAMA. Recently, they bought millions of shares of SLV. And I've been hearing from contacts that the central banks now are starting to buy silver as well. How do you see that? Any?
I think it's very interesting. The United States does hold some silver. I look more carefully at the notes to the Treasury's balance sheet, and they do list. I can't tell you the amount, but they do list silver holdings. But I don't see those held as an asset for some reason. Maybe they're just too trivial. You only see gold on the books, gold certificates on the books of the Fed. But we do own some silver. I think it's significant in the United States this year. The governors of two major states, Governor Abbott of Texas and Governor DeSantis of Florida, passed legislation to say that people can use gold and silver employing digital platforms. I mean, very sophisticated ways with credit cards or however they set it up to carry out everyday transactions tax-free in those countries. And both of them cited the constitutional justification for that because only silver and gold are mentioned in our Constitution as the legal way to denominate borrowing on behalf of the states, but they're using it to facilitate payments. And it's always been seen in Texas as a way to challenge the Federal Reserve. Texas actually has a state run and managed gold bullion depository. So all of this brings up, I think we'd need new capital gains treatment of gold and silver. I would advocate for both from a federal point of view, because even President Trump in 2011 accepted 3 kilo bars of gold as a deposit for property he owned in New York at 40 Wall Street. And he had a press conference at the time and said, I'm accepting this gold because, yes, I'm making a statement about the dollar. This was during the Obama administration, and he felt that the dollar was being cheapened by the economic policies of that administration. And he said, so I want everyone to see that I prefer to be paid in gold. I think it would be interesting to explain or confront the president here and say, now that gold was worth 176,000 at the time. I think today it's worth more than twice that much. But the other thing is the capital gain would be taxed. And if he had accepted the payment in dollars, in dollar bills, they wouldn't be taxed. He could, if he just put them under his mattress, he could use them today. There'd be no capital gain on them. On the other hand, they would have lost considerable purchasing power during those intervening 15 years, which even if the Fed hits 2% a year, there's a third of their value lost in terms of purchasing power. I think that's an interesting mind experiment when we just bring up the concept good as gold and what that had previously meant as far as American monetary history.
I wanted to ask you, in lieu of what we've been talking about, gold and a new prospect of a new monetary system for the world, how would the power of the Fed be impacted if gold became a lot more important? Is that, I mean, for me, I think it would be a good thing because it would mean the Fed would be kind of yeah, they would be handcuffed. They wouldn't be able to do as much as they've been doing for the last 25 years or so.
Well, Mario, I've only gone so far in my own prognosticating about the impact on the Fed with regard to this very straightforward proposal, because we don't know if we're talking about $1 trillion issuance and whether that would be replicated in private markets, or we don't know if it's just we'd only set up a portion of our gold holdings and just do something like Series E savings bonds, something a smaller basis. But it seems to me that in the same way that TIPS bonds, which were really created under our Treasury Secretary Robert Rubin in 1999, they are very important to the Fed. The Fed regularly looks at the difference between the yield on TIPS bonds and the yield on Treasury securities with the same tenets of maturity and such to get a sense of aggregate expectations of future inflation. And so this could do the same thing. You could look that the Fed could look at and take into consideration the yield on gold-backed treasuries relative to at least the 30-year treasury bond and get a sense of aggregate expectations about future purchasing power relative to gold, if gold is indeed some kind of a surrogate for the underlying economy or at least for commodities, and whether that could ever become a formal price rule really depends on whether the Fed is ever going to make itself subject to any kind of rule. Because we remember when the idea of a price rule was proposed by members of Congress, Janet Yellen, as head of the Federal Reserve, said we do not want to be bound by any kind of mechanism, any kind of rule. We want total discretion, which is sort of surprising that the United States would allow a government agency to have total discretion. We've already seen that the head of that agency cannot be fired, or at least would fight it, or even people on its board who vote, can they be fired, even for cause? These are questions we're wrestling with now that may ultimately go to our Supreme Court, because it is an agency that was set up, and presumably the head of that agency could be fired by someone. Otherwise, they're really become almost superior to an elected president. So those are interesting ideas. But my point is that if the yield on a Treasury trust bond, I'm calling them, but one with the convertibility aspect, gets enough public attention that people say, look, the yield on that is almost nothing. It's such a cheap way for the government to borrow compared to what treasuries. And I mean, our interest expense on treasuries is now greater than what we spend for the Defense Department. And shouldn't that then impose some kind of a rule on the Fed? Not necessarily, in my view, to raise the interest rate, but to do what Paul Volcker tried to do. He said he was never trying to manipulate the interest rate up to fight inflation. He was trying to reduce the money supply. He was doing a pure monetary Milton Friedman approach of trying to reduce the monetary base, or he would focus on M1 and M2, these monetary aggregates. He was trying to reduce the money supply. And maybe you could try to get the Fed to reduce the money supply, or even force the Fed to reduce the money supply if you went beyond a certain threshold in the difference in yields between Treasury trust bonds and traditional Treasury securities.
Judy, here's the chart of M2, and as you can see, it kind of picks up after 1971, and with the exception maybe of after COVID, when it came off a little bit here, we're going back up, and it's making all-time highs, M2. And to me, that is inflation itself. And the CPI is like a consequence. The rise in CPI is a consequence of it. And we've recently seen that, yeah, even President Trump is talking about that, but he calls it the affordability crisis.
That is, you're brilliant to bring up these charts. Thank you. Thank you. That's very helpful for me to see. And the references that you've been showing almost instantaneously. That's very helpful. Yeah, I think that's an informative chart, piece of information to see, because now we have the Fed, even as they're talking about reducing rates, they're talking about buying more treasuries. And that's troubling to me because that was the definition of quantitative easing when they engaged in large asset purchases in the wake of the 2008 global financial crisis. So instead of reducing their portfolio, they're talking about increasing base money again. Because when the Fed buys treasuries, technically they can't buy them directly from the government, but they buy them from the banks who own the treasuries, and they do it by increasing the cash balance reserve account of those banks, and that is base money. That's M0, and that has always in U.S. banking been the amount that banks can then use to multiply to make loans. Now, the problem now is I think banks are happy to keep the money just sitting there, doing nothing. So then what the Fed has really done is they've just changed the parameters of treasury debt issuance. Because whether a bank owns the treasuries or then has them converted into cash balances that sit at the Fed, they are both riskless, government guaranteed use of funds that generate a return for the bank. But in the case of treasuries, at least you're financing a deficit, but presumably the government is spending for infrastructure or for some kind of fiscal reason that has some justification. Maybe it's to build new capabilities or to educate people or to do transfers until people can get back on their feet and rejoin the workforce. But when the money is just sitting there at the Fed doing nothing but collecting interest, and the big problem for the Fed, the reason it's been losing money, banks are collecting interest at a higher rate than the Fed is generating on its portfolio of those very treasuries it bought from the banks. So the Fed reconfigured the parameters, the interest rate and the duration, because now all of that is short-term money. That's why we get these strange anomalies where the so-called Fed funds rate, even though there is no federal funds market anymore, there's no overnight borrowing of reserves by banks because there's no reserve requirement, but we use that old name to describe the administered rate, which is the Fed funds rate is in between what the Fed pays on cash reserve balances and then the reverse repo rate, and that's usually 10 to 15 max basis points. But that's how the Fed tries to tightly manipulate interest rates. And I just think that's a very unhealthy practice. And the reason I think the Fed might do it is they're concerned now that as their rate goes down, banks are saying, well, I might as well buy treasuries. because if the Fed's going to keep coming down on this very short term overnight rate, maybe 2 years from now, I will have wished that I had locked in a certain rate on treasuries, and I'm indifferent whether I hold my cash reserves at the bank or invest them in treasury. It's all government lending. And now I think the Fed is thinking, well, we want to buy the treasuries to reduce that yield so the banks keep the money in their cash balance reserve accounts. And I just find that is perverse in terms of the Fed's role in the economy.
It's like they're trying to stop the banks from lending to the real economy.
Precisely. The
Okay.
Fed has now set up a new mandate for itself to be in charge of liquidity, but that's not necessarily for productive investment. We know it's a long-term commitment of investment that actually raises living standards, that produces real prosperity because it has to be patient capital invested in plant and equipment. And it might be years before that seed money results in a greater harvest. But that's real money. That's real investment for the real economy. As you say, those are the loans. Banks should be making loans to small and medium-sized businesses to expand plant and equipment, to hire more people. That's productive investment. But instead, they say, why do I have to have another loan officer when I can just have the money sit there very passively and collect the interest from the Fed with zero exposure to risk? But without risk, capitalism doesn't work.
Yeah, and I think, Judy, at the beginning of the Federal Reserve, they didn't hold any government securities, and they actually facilitated commercial paper financing, which commercial paper is all to do with the real economy.
Well, we know that banks used to prefer to be totally loaned out. There were many banks that were loaned out. That's why you had a federal funds market, because once a week banks had to meet the reserve requirement with the Fed. But the Fed's approach was system wide, so it was fine with the Fed if, to meet the reserve requirement just for that day, to reconcile with that bank's own reserve requirement needs, they could borrow the money from a bank that had surplus reserves. And it was the interest rate charged by that bank that was the Fed funds rate. And that is how the Fed engaged with market forces to try to control the money supply, because the banks were the multipliers of that base money. But now the base money is exponentially above what would even be considered useful as far as reserves. We have excess reserves. We're beyond ample reserves, which was the name, the euphemism the Fed uses, but we're to something higher than that, abundant reserves, which a few of the governors of the Fed use that term, such as Christopher Waller thinks we have abundant, meaning too high.
So, I mean, from what you're telling me, it looks like the Fed and the banks, I guess they're the primary dealers. They're running like a total like financial engineering scheme just to enrich themselves while the rest of the economy suffers. And no wonder the 50 bottom 50% only own, I think, 1.7% of the wealth.
Well, this to me is one of the real sad aspects of current financial and monetary arrangements. You have some of the greatest talent, the quants coming out of college, just geniuses with numbers, often people who went to MIT, the same people who developed the option pricing model. I mean, the brilliant ones who put together credit derivatives and I mean, the Bank for International Settlements shows over 600 trillion as the notional value of outstanding derivatives, over-the-counter derivatives, and these are people betting on the differential rate paths taken, say, by the Fed versus the European Central Bank or other major central banks. These are contracts that are linked to the currency gyrations. These are all profitable and totally legal opportunities to arbitrage these little glitches that are strictly the result of the illogic and anomalies in these monetary arrangements. And so people get rewarded for taking advantage of that. You have over a $9 trillion daily turnover volume in foreign exchange markets. And again, you're just arbitraging these financial opportunities and making tons of money. And you have people, as you say, who just are lucky enough to have financial assets. Today is a very critical day in our market, but we know that huge gains have been captured by people who are sufficiently well-to-do to have financial assets, and all of that has grossly exacerbated wealth inequality. And I think that's all traceable to the Federal Reserve and the way central banks operate around the world, which is it's so retrograde compared to the classical international gold standard, which was so liberal, even progressive, you might say, in terms of providing greater opportunity on a more ethical and orderly basis for true global competition that was not based on governments manipulating currencies or interest rates.
Uh, Judy, that was a really good talk with you. We really covered a lot of ground, and I didn't expect to talk about how you see the Fed operating, and it's a huge yeah. It's called financialization, I guess, but yeah. Thank you very much, and we'll keep in touch. And I wish you the best of luck in trying to push your idea of sound money to the current administration.
Well, you're an inspiration to me and to many other people, and I appreciate your giving me this opportunity to talk about these ideas. And your questions and your comments were immeasurably useful and helped get the points across. So I'm grateful to you, Mario, and I appreciate our friendship.
Thank you.